Hi, I'm John Hageman from JLL. Welcome to KNN. Today I'm here with Bob Knakal, and today we're going to talk about the current market conditions of the investment sales market in New York City. So Bob, the first quarter is behind us. There's been a lot going on, especially over the last 30 days. Tell us what we've seen in the market so far in 2023.
Well, it's been an interesting ride so far in 2023, Hags, and we don't have the first quarter stats in yet, but I'm sure that they're going to show that sales volume is down a little bit from where it was previously. But, you know, I always like to give some relative perspective. So let's go back and see where we are from 40,000 feet. Clearly, the peak of the market cycle was back in 2014 and 15. Now we're talking about 9 years ago already. But that was the peak of the market. The New York City investment sales market has been in correction mode essentially since October of 2015, except for that one 12-month period we had second half of 2021. First half of 2022, that 1 year period was actually pretty good. But then the interest rate increases that the Fed started implementing in March started to really impact the market in September of last year. And so we've had this downward pressure on property values, downward pressure on sales volume. And so we're at a point now where we're challenged to find sales volume. The only folks that are transacting are folks who really have to, or there are compelling externalities why they are motivated to sell. And so that's driving the market. But the most interesting thing, I think, about today's market, and if you compare it to the savings and loan crisis in the early 90s, the recession in the early 2000s, the great financial crisis, 08, 09, the one thing that is glaringly different about today's market is that each product type is performing very differently and independent of other product types, where in those past three big downturns, the whole market was moving in unison. And yes, it's true that typically when we're going into a downturn or out of a downturn, the residential market dynamics will tend to lead the commercial market. But here, it's almost as if all product types are completely uncorrelated and moving in different ways.
So with that, why don't you start with, we can go through each one, but maybe start and tell us what's happening in multifamily today.
Multifamily market is actually a big surprise.
I wanted to start with something that's positive.
That's right. No, it's been, I think that clearly there's been downward pressure on values because interest rates have gone up. And interest rates and cap rates are highly correlated. And if you are a close observer of what's happened in multifamily in New York, we see that we've had periods, extended periods, where cap rates have been lower than lending rates, notably in the mid-1980s and then again 2004 to 2007. But it's important to note that the reason why cap rates were lower than lending rates during those periods was that in the mid-80s we had every elevated apartment building was being converted to co-op. So there was an exit strategy that was above and beyond just cash flow from the property. Same way in 2004 to 2007, it was condo conversion. So I think if we peel those conversion properties out of the data, we'll see that we really didn't have periods where cap rates were below lending rates. They're highly correlated. They may be a little higher, a little lower, but generally correlated to lending rates. And I think that's what we're seeing today. So we have cap rates on multifamily that are very, very closely tied to where borrowing rates are. That's higher than it's been in the past, so that's exerting some downward pressure on value. But the interesting thing is the amazing amount of demand that we have. We saw the rent regulation policies change very dramatically in June of 2019. That was a gut punch to the industry. Then we had the pandemic. We've had the interest rate increases, but notwithstanding all of that, we've had significant changes in the multifamily market relative to market participants. A lot of the old New York families and high net worth investors that only bought New York multifamily for a long time are now buying around the country. We have new folks that have come in. And the thing that's the most surprising is the very diverse demand that exists for multifamily today. And so that market actually is performing pretty well, particularly for properties that have a value add component to them. So multifamily, yes, cap rates are up, a little bit of downward pressure on value, but that market is still performing fairly well.
Now that we cover multifamily, let's talk about land.
A land market, okay. Well, the biggest impact on land, and we have to disaggregate land into three major buckets,
Sure.
right? You have commercial land, and then on the residential side, you have rental land and condo land. First, commercial land, very little of it is trading. The hotel land has not been trading that much because there are so many hotels that are available for sale, and those hotels can be purchased at less than land value was several years ago at the peak of the market. So there's not much going on in the new construction hotel sector. The office sector has seen very little trades for land, but that market actually is seeing very good pricing because Class A office, and we'll get to office in a minute, but Class A office, new construction is doing really, really well, and that's helping land values there. But let's look at the residential land market because that's where we spend most of our time.
Sure.
Most sites that are zoned for commercial and residential are built as residential because that's a higher and better use in a lot of cases. So if we look at the rental land market, it's completely dried up. There's a huge air bubble. The Affordable New York Tax Abatement Program has expired. It's effectively the new incarnation of 421A. Doesn't exist. Nobody's selling land for rental construction. And in fact, we're telling clients, if you're thinking about selling a site and the highest and best use is residential rental, don't sell it today. There's no value. So that market is completely dried up, but we are seeing good activity in the condo land market. Now that is primarily in Manhattan, some areas within Queens and Brooklyn as well. But the interesting thing in that market is that these interest rate increases that really started to impact lending in September of 22 exerted downward pressure on land values, mainly because the increases in lending has caused construction loan pricing to be so high. So it used to be in the sixes. Today it's over 10%, and that's exerting downward pressure. So we've seen land values drop by 20 to 25% since September, but there still is a good level of demand for sites in that new price threshold. And there are even some better quality sites that are seeing some surprising pricing and achieving surprising pricing. So that market is still pretty good because I think developers feel as if market conditions to sell condos is going to be much better 3 years from today than it is now when that product will be coming online. So land market's still seeing some pretty decent activity, and we expect that to continue.